Welcome back to the Jameson Brandon channel, where we talk about all things money. Today, we're going to catch up on an Empire alert. This is usually a paid alert. It was sent out yesterday, so you guys are getting this a day later, which is great. We're up to 482 emails that I've sent. You know, it's kind of crazy because you start something and you don't realize, you don't think about like, yeah, I want to write, 500 emails or 1,000 emails or whatever you end up doing. Before you know it, if you just take things day by day, you get there. And so coming up on a big monumental occasion, I guess, which is number 500. I don't know, maybe you've got some ideas on some cool stuff we could do. Go ahead and comment below if you got an idea there. But in this email, we're just going to cover, there's been so much drop this week and there's fresh data that's coming out this week. Just a busy week with economic data, and so there'll be another email going out today that is a paid thing. It's $1 a day if you want in on it, and that's all there is to that. But today we're going to cover CPI. So this video is about inflation and CPI, which I think maybe we're getting wrong because everyone's talking about inflation now. And usually when even, economists on TV are talking about inflation and talking about inflation going to get 15%, I think that's when that's probably not going to happen. Kerry Wood brings up a good concept of like, hey, maybe the inflation is over and we're going to get into deflation now. Whereas I think the milkshake theory, the dollar milkshake theory, talks about a hyperinflationary period for longer. I just don't know, right? It might be a hybrid of the two. We might have up and down, we might have hyperinflation, then deflation, and it just keeps kind of going like this over and over and over again before the next big rug pull. It's hard to tell, but let's jump into it. The expectations going into this from the actual Fed's own survey was, I believe, 4.8%. That was for June. And then the actual came out at 5.4%. So not crazy, not some people I think were expecting double digits. There's a 4chan post that was going around, which I guess these things are hit or miss. It's like 1 out of every million posts are probably like some legit alpha, but it's not really something that you can base trade decisions off of or anything like that, unfortunately. I knew that CPI was going to come in higher, so I did close out quite a few crypto positions I was in, and I was in a gold position, and I closed that out as well because, gold just doesn't really respond well to inflation data, FOMC meetings. It's just like, it's stupid because all Jerome Powell has to do is come out on TV and like 99% of the time, the dollar's going to pump at least a little bit. The dollar index, whatever, is all going to go up and, metals will go down. It's unfortunate because I really think that, metals like Bitcoin is also being suppressed. So I think metals and Bitcoin are all being suppressed equally now that institutions are in crypto, right? Which it's funny, going back to 2017, everyone was begging for, institutions to come into crypto, and now they're here, and so now you get what you get. Anyway, 5.4%, which is high. I think it's interesting. I've seen quite a few people trying to compare this data and where we're at right now with data from the 70s. It is pretty hard to do. But anyway, the 1/3 of the pump of CPI came from used cars, believe it or not. So this is the largest increase reported since 1953 when they started actually doing this. What else we got here? Goods prices rising faster than services. Goods up 8.7% year on year. Fastest annual surge since 1981. Shelter rent is now surging. Keep in mind that they don't put mortgage data and new home data, I don't believe either, into CPI. I talked about this in depth before, but I forget, I forget often. So I don't try and memorize data like that, but go through CPI for yourself. Like, here is the metrics. There is quite a bit that's missing out of it. It's almost like a stacked data point that they can roll out and say like, hey, see, everything looks good, or hey, see, everything's not good. It's not really covering the full scope of things, right? New home builds are up, I think, $35,000 to $40,000, depending on which state you're in. Overall, because of inflation on lumber, steel, etc. Steel is still up, even though indexes might be down, and lumber prices from a stock market standpoint might be down, like the indexes and ETFs and all that. But the cost of wood, I can assure you, has not come back down. So it's just kind of funny to me. It's like the ETF price, the index price is not indicative of the price that you're going to go pay at Home Depot right now to buy a sheet of OSB or a 2x4, right? It's come down a little bit, but it's still up. Okay, so another thing I wanted to touch on here is rate hike discussion. If we're in a hyperinflationary environment, understand that the only thing that can combat inflation or hyperinflation that the Fed has at its disposal is a rate hike. We raise rates, it drops inflation. Okay, that's how this works. Traditionally, unless there's some new vehicle or new way of handling this that's all of a sudden invented, that's all they really have at their disposal. So right now, I think that the market is still being way too optimistic in thinking that there's only going to be one rate hike by the end of 2022. I think there's going to be many rate hikes. I think there's going to be probably 3 or 4, because if this inflation is in fact a problem, they'll need many rate hikes to bring it back down. If it's not, and we're already getting into deflation, well then, yes, this is probably more accurate. One rate hike in the entire year. that seems more plausible, but I guess we'll just have to see. The next quarter will be really, really pivotal because we have a lot of things happening. We've got this disaster of a repo market coming to a head within probably the next couple weeks. We've got all the extended unemployment benefits coming to an end in September. And then we've got a few other things at play, which I've been covering in the emails. I just can't think of off the top of my head. And by far the most important question we should be asking, which Jim Reed from Deutsche Bank asks, he's a credit strategist over there, is first, whether this current bout of inflation is temporary or not. How did consensus once again, for the third month in a row, completely miss the inflation? How did Powell and Yellen once again miss the fact that there's inflation this high? Second, with inflation forecast creeping up even higher, at what point will the surge in 2022 inflation render the transitory debate moot? This, I guess, is like, the ultimate gotcha that's floating around right now, which is that Jerome Powell came on for a FOMC meeting or FOMC meeting and said, hey, inflation is transitory, it's not gonna stick around. Well, that's bullshit. Like, shut up. We're all seeing it. Like, we're seeing it in our daily lives. We're seeing it, with the shit we're going and buying at the store, from gas to food. So, there's over 10 companies now that are gonna pass on the rate hikes to you. And some of them, they're not even gonna do it until September. So how is inflation transitory if rate hikes for consumer goods is planned in September, which is 2 months away? How's that transitory? Transitory isn't a 1 month thing, a 2 month thing. That's, now we're getting into permanency. We're getting into, I guess, a descriptor that should not be used like that, right? Transitory does not cover that. We'll see what happens with that, but that's really what's on the table, and that's really the direction that we could go, right? Is that maybe the hyperinflation is going to cool off and we get into a deflationary. Maybe hyperinflation continues. We'll just have to kind of see and keep an eye on the indicators of what we're seeing. Consumer confidence data should be coming out soon too. That'd be interesting to take a look at. Obviously, CPI came out lower than it could have, I guess. If the double-digit CPI stuff did come out, well, then that would have been like run for the exits in all markets, in everything, because that would have been disastrous. But 5.4% up higher than what they were expecting on their own survey data. Again, not world crushing to me. So there you have it. There's an update on what's going on. If you like this video, just take a second, help us get up in the algorithms, help us spread this video out. It just takes a minute. Just click the like button, comment below if you got something to say. If you're brand new to the channel and you like this sort of thing, then click the subscribe button. If you don't want to miss out on the uploads or get notified more often, hit the bell notification. Be on the lookout. More videos coming soon. See ya.